exits are far more, in terms of volume, I mean, they're happening at much more frequent, periods than, say 5-6 years ago, when the question was, the big question was, where will the exits come from? Because, the IPO market was not doing well. Therefore, you necessarily had to look at strategic exits, or you were looking at secondaries, right? And secondaries, not too many secondaries were happening about 6 years ago. So you see a lot more activity on all fronts. What is more interesting is exits of a different kind, which I would call funds-led M&A. So funds are bringing together different companies, maybe funded by two different funds, maybe the same in the broad spectrum, and getting funded companies to come together and become a larger company. So we see quite a lot of that happening as well. But I think what was interesting for me in your presentation was, I don't think the entrepreneur really is thinking about exit when he's starting, right? I mean, he's thinking about, making it big. So passion is, more or less what is driving him. Very few entrepreneurs actually think of exit. And depending on the industry, I know some entrepreneurs who, when they get into a business, they know they have a horizon and they have a definite plan of exit in mind for themselves and for the investors. But otherwise, most founders are not thinking of exits.
I think the Indian startup and funding ecosystem is in a very, very good state at this point of time. Way back in 2015, when we were exiting free charge, after 3-4 months, after that, there was somewhat of a downturn, and it was looking like things are all falling apart. And I don't know how long this winter is going to stay. But things are quite back on track. There is a lot of money out there amongst VC funds to invest. There are a lot of awesome quality founders who are now solving a lot of deeper problems, because a lot of those low-hanging fruits have been captured. So a lot of deeper problems are now getting attention. And at the same time, exits are also becoming much more interesting now. If you sort of look at it, in 2012, when we exited Redbus, it was $110 million deal, but it was the largest tech M&A that had happened in the history of the country till then. And then happened Myntra, then happened Jabong, then happened Freecharge at $440 million, and then happened Flipkart, then MediaNet, a lot of these things. So if you look at it, every time previous record has been broken.
I think I'd like to echo a lot of what Alok said, right, which is we are very bullish on the Indian startup ecosystem for several reasons. One is, if you just look at, I think, the financing availability across different stages, right? I think 5 years ago, there was a dip. I mean, so at the early stage, yes, you can raise money, but then specialized early stage funds at the A stage, at the B stage are probably not as many as what you see today, and of course, we fall in that category. But also at the late stage, you have specialized investors for every stage which are coming in, which signifies there is a lot more depth, and that's always healthy for the ecosystem. Also, I just think the quality of founding teams that you see now, especially because many of them have seen a growth journey earlier, I think that adds up a lot. I would probably even investors have seen some of that journey. They have seen a little bit of the ups and downs. So I think investor maturity also has gone up. And last, there is a lot of the building blocks that you need to create businesses in place today, right? I mean, 7 years ago, even up till maybe 8 years ago, when e-commerce was starting off, you had to solve for payments, you had to solve for logistics, you had to solve for just getting digital penetration to go up. Today, you don't need to worry about payments. I mean, India is so far ahead in payments than most other countries in the world. You don't need to worry about logistics by and large. Marketing has started becoming easier because more and more people are coming online. So it's just easier to start and easier to scale. And we start seeing that for all of our, I mean, not all, but many of our portfolio companies already. So I think that's one about just where our perspective is.
I think there are a couple of differences that come out as a clear trend. First and foremost, the companies which tend to hyperscale and are successful at doing that are the ones who are investing ahead of the curve on hiring great talent. So you take examples like Harsha, you take examples like Rivigo, you take examples like Meesho. The other companies who have actually always invested ahead of the curve, hired maybe 6 months to a year ahead. So if you are at certain scale, you think you'll be at this scale in a year, you actually start thinking about what kind of problems I'll start facing in near future, and then start preparing your machinery for handling those kind of challenges. And ultimately, if you look at it, a founder is able to execute only as much as his team is executing. In very early stage, day zero, it is pretty much founder who is doing everything, whether it is engineering, product, marketing, sales, whatever it may be. But as the company grows, founder still has got only 24 hours, out of which he might actually work 18 long hours onto the business. But the problems are actually multiplying at an exponential scale. So either founder just keeps working harder and harder, in which case he will soon run out of time and then he can't scale up further and things don't make progress, or he hires other people which give him leverage to actually execute more. And the founders who are able to hire good quality people, probably even better than founder himself at doing work of a specific functional area, are the ones who are able to create massively scaling companies in a successful manner. The second thing that I would say that differentiates a company that scales up successfully versus doesn't scale up successfully is how much of introspection and self-grooming founder does for himself.
See, the most successful agreement is something that you never open. Okay?
Yeah.
So, and I would actually take off from where what Alok mentioned about learning. I don't think entrepreneurs should look at legal issues as something that is outside the scope of their business, right? It's part of being an entrepreneur. And you can learn. And law is not complicated. I know I'm not helping lawyers by saying that, but it's not complicated. It's English, it's common sense, and a little bit of logic. So the 2-3 things that I normally tell founders when they're dealing with funders and amongst each other. One, clarity and certainty, right, in the relationship. Yes, things can always change. You never know when there's a event outside your control which can influence how things work. But be very clear as to what your relationship is with your co-founder and what your relationship is with your investor. And no investor and no founder, they don't want to end up in dispute, right? They want to make it work. So everybody is coming to the table with good faith, to wanting things make work. Yes, a big fat document is written, but that is to protect the worst case scenario. So have clarity and have certainty and communicate and learn. If there's a problem, there's no point in hiding it, and it only makes you look bad to the investor.
I think just having very strong clarity and communication even between co-founders is very, very important. Especially I think what happens is that as you're starting off, everybody is on the same page, everybody wants to build a very large company, wants to solve a large problem. Often in the firefighting that happens of building the company on a daily basis, I think what happens is while you're worrying about how this employee is feeling or how this senior hire is feeling or how do I get this person on board or how do I create a career path for these people because they need to grow. Often I think the co-founder relationship actually gets taken a little bit for granted.
Let's say there are two couples. In one couple, both husband and wife think that if there is a fight, there is a way out. We'll divorce and we always have a way out. In second, the couple thinks there is no way out. We have to make it work. Which of the two couples have a higher chance of sort of surviving the relationship over the long time? I would say the couple which thinks that there is no way out, we have to make it work, is the one which is going to have a higher relationship survival rate. That is how it works in the startups also. Unfortunate reality that needs to be understood is founder disputes is the number one reason why startups fail. Because even before they encounter the pressure from the outside world or the challenges from the external environment, these internal disputes end up basically hollowing them up in a way that they can't even face those kind of external challenges. So it's very important to recognize that these kind of founder disputes do happen and have a upfront clarity on those things early on. If you think you are more valuable onto the table than your co-founder is, have a clear discussion about that when starting the company. Maybe have an unequal equity distribution Don't go with just an equal equity distribution today for you to realize 3 years down the time that, hey, why I'm sharing this much with my co-founder? Because that kind of thought process is going to be a very negative thought process at that point of time. So I would say some of these things are important to consider early on when starting up the company.